And welcome. We've all been there. You make a big purchase and wonder, was that really worth it? Well, businesses ask that exact same question all the time, and they have a super powerful tool to get the answer. Today, we're going to dive into return on investment, or ROI, and figure out how it helps us measure what truly matters when it's time to make a big decision.
See, at its core, pretty much every business decision boils down to one simple, fundamental question. It's the same when you ask yourself after dropping a bunch of cash on something new. Was that a good use of my money? So let's make this real for a second. Imagine your company just spent 10 grand on a really flashy new marketing campaign. Ads look amazing, everyone's talking about them, but did they actually help the bottom line? How do you even know if it worked without just, guessing? What you really need is a simple, straightforward way to grade your spending. Kind of like a report card that tells you in plain black and white whether an investment was an A+ or a total flop. And that right there is exactly what ROI is.
Okay, so how does this report card actually work? Let's get into it. The most important thing to get about ROI is that it's a percentage. It's not just some big dollar amount. It gives you this clean, simple score that measures how profitable something was. This means you can compare totally different kinds of projects, like a marketing campaign versus buying new equipment, on an apples-to-apples basis. Honestly, the best way to wrap your head around this is to just walk through the math. And don't worry, it's way simpler than it sounds, I promise. First things first, let's say our project brought in a total of $4,000. This is our gain, the total money that came in because of our investment.
And to make that $4,000, we had to spend $3,000. That's our initial cost. So there you have it, our two key numbers.
The whole thing is really just two easy steps. First, you figure out your net profit. You just subtract the cost from the gain. So in our case, that's $4,000 minus $3,000, which leaves us with $1,000. Easy enough, right? Then you just take that net profit, that $1,000, and divide it by the original cost, and then multiply by 100 to turn it into a percentage. And boom, there it is, a 33.33% ROI. So what does that mean? It means for every single dollar we invested, we got that dollar back plus about 33 cents in pure profit. That's our grade on the report card. Hey, not too shabby. But here's the thing. ROI isn't just for grading stuff you've already done. Its real power comes from helping you look into the future and pick the winning investment. Imagine you're looking at two options. You've got Project A, which is projected to have a 20% return, and Project B, with a projected 50% return. All of a sudden, the choice becomes crystal clear, doesn't it? Assuming everything else is equal, you're going to pour your money into Project B to get the biggest bang for your buck. Okay, but this is where we have to be smart about it. A huge ROI looks fantastic on a spreadsheet, but that one little number, it doesn't always tell you the whole story. Yeah, just like a school report card might not tell you if a student is a great artist or an amazing team player, the ROI report card has some pretty critical blind spots you absolutely have to know about. The first huge problem really comes down to this one question, because let's be honest, the answer is a big fat no. And that means any ROI calculation that's based on the future is, well, it's built on shaky ground. Look, figuring out the ROI for a project that's already finished is simple. You have the real numbers. But for a future project, you're basically making an educated guess. You're forecasting. What happens if the market takes a nosedive? Or what if your project costs way more than you planned? Your amazing projected ROI can just vanish overnight. Now, for the second blind spot, think about this for a second. The formula we just used, there's no spot in there for time, is there? And that, my friends, is a huge missing piece of the puzzle. Just look at these two scenarios. A 50% return sounds fantastic, right? But would you rather get that 50% return in 3 years or wait an entire decade for it? Of course you'd want it sooner. But ROI by itself doesn't care about the difference. That's why people in finance often use other tools like the payback period to figure out how quickly they'll see their cash again. And that brings us to our final and maybe the most important blind spot of all. Some of the most valuable things that come out of a project can't be measured in dollars and cents. How do you calculate the ROI of having a better reputation or the value of getting your brand known in a whole new market? These things are incredibly important, but they just don't show up in a standard ROI calculation. Smart companies know this, and they use broader tools like a balanced scorecard to keep track of that kind of strategic success. All right, we've covered the what, the how, and the watch out for this. Now, it's your turn. Let's put that knowledge to the test. Here's the situation. Your company spends $5,000 on a new piece of software. Over the course of the year, that tool saves the company $7,500 it would have otherwise spent on paying people to do that work.
So what's the ROI? Take a second and think back to our formula. The gain minus the cost, all divided by the cost. What do you get?
If you picked B, 50%, you nailed it. The gain was $7,500, the cost was $5,000, so your net profit was $2,500. You divide that by the original $5,000 cost, and you get 0.5, or 50%. Awesome job. So here's the big takeaway. ROI is an absolutely essential tool for measuring profit. But true wisdom in business is knowing that it has limits. The really crucial question isn't just what's the ROI, it's what does success really look like for this project? And how do we measure all of it? And that's a question every smart leader needs to be asking. Thanks for joining this explainer.